With any investment, we're taught to diversify, to reduce risk and hopefully to maximise returns, but most people fail to do this with peer-to-peer lending. Perhaps they feel that because they are diversified across many loans on their chosen platform, that they are safe.
The recent collapse of peer-to-peer lending platform Lendy has gone to show that peer-to-peer is not free from risk and that you could potentially lose all of your money. As advocates of peer-to-peer lending, we obviously think that this is unlikely, and Lendy was a platform that we did not personally endorse. However, there are things that you can do to reduce the platform risk.
So how do you reduce peer-to-peer lending risk and maximise returns? Let's check it out.
Welcome to Unshackled.com, the investment channel and website that sets you and your finances free. This is Andy, I'm Ben, and if you like what we say, click the like button and hit subscribe. Let's get into it.
What happens when a peer-to-peer lending platform goes bust? Let's take a look at the case of Lendy. Lendy was a peer-to-peer lending provider which spectacularly went into administration, leaving lenders wondering if they received any of their investment back. In the words of the administrators, a key part of their role is to safeguard the loan made through the company to the various borrowers.
This sounds moderately positive, but it's unclear how much each investor will get back. As the loans are between the lender and the borrower, one would hope that they would get the majority back, but only time will tell.
How to stop this happening to you? Firstly, you need to consider the returns that the platform is offering. It is our understanding that Lendy was offering a 12% interest rate, which is absurd because we're living in an era of record low interest rates. Contrast that with the more realistic 5 to 6% returns that we talk regularly about on this channel. If the lender is receiving 12%, the borrower must be paying even more. These were clearly very high risk borrowers.
So, rule number 1, don't chase ridiculously high interest rates. If the rate looks too good to be true, it probably is.
Don't invest what you can't afford to lose. To us this is obvious, but time and time again people continue to do this. We came across this comment on Trustpilot in regards to Lendy. The person criticises the lack of warnings and says he can't afford to lose the money. We don't mean to rub salt in his wounds, but why has this person invested money he can't afford to lose in a high risk investment platform?
We hope that the lessons he has learned is not that investing is bad or that peer-to-peer is bad, but instead, rule number 2, only invest what you can afford to lose, and rule number 3, only invest in what you understand in.
Diversification. Every peer-to-peer platform that we've come across encourages you to invest enough money to ensure that you are diversified enough across multiple loans on their platform. This is usually at least 50 to 100 plus loans.
This is absolutely critical, and we suggest that you ensure to do this. In fact, in our opinion, your exposure to any one loan part should be no more than 2%, and in our opinion, much lower.
In fact, this extract from Funding Circle says they suggest you invest at least £2,000 so you achieve diversification across 200 businesses and have exposure to any one business of less than 0.5%.
Diversification does not stop there. What they don't really tell you, and nor does any peer-to-peer platform for that matter, is that you are still rather exposed to the platform itself. Perhaps your chosen platform is a terrible business in itself and cannot carry out proper risk assessment of loans. The loans that you invest in could potentially all be rubbish.
This is why it is also critical to invest across multiple peer-to-peer lending platforms. This way you are spreading your risk. This is also a fantastic way to boost your returns because the peer-to-peer lending market is very competitive and they are all offering very generous referral bonuses to obtain new customers.
If you're interested in taking advantage of such referral bonuses, we have loads listed on our website, Unshackled.com, where you can earn several £100s in bonuses from very popular and, in our opinion, responsible peer-to-peer platforms. We will be adding lots more over time.
We have also reviewed these platforms and you'll find the videos on our Money Unshackled YouTube channel and the MoneyUnshackled.com website. How many platforms that you choose to invest across is up to you, but a balance between practicality and risk seems like the best approach. We like the idea of about 5 platforms, but this totally needs to be based on your comfort level. Might as well get the referral bonus from each platform too.
The ISA problem. A major problem is that you are only allowed to invest into one innovative finance ISA in each tax year. We believe this to be a stupid and dangerous limitation set by the government, as it encourages people to under-diversify. It is worth noting that if you are a basic rate taxpayer, you don't have to pay any tax on interest up to the first £1,000, so you might not even be concerned about this.
In any case, it's probably best to go for safety first by utilising multiple general accounts alongside your one ISA. Better to be safe than sorry. One technique that we use is to open up a different ISA each year. Of course, those juicy referral bonuses will help to soften the blow of any potential tax.
New FCA rules. It goes without saying that you should have investments across different multiple asset classes. Well, the FCA is placing a limit on investments in peer-to-peer agreements for retail customers new to the sector of 10% of investable assets. We're not sure how this can actually be enforced, and how a platform could even know, other than if you gave a declaration, what other investments you have.
We understand why the FCA would want to implement this, because peer-to-peer lending at first glance seems very similar to saving in a bank, but the risks are very different.
Question of the day: will you be spreading your risk across multiple peer-to-peer platforms and taking advantage of the sweet referral bonuses while you're doing so? Let us know in the comments below.
Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money. If you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.